So good morning, everyone, again, and welcome to the second annual Business and Finance Law Conference. This year's conference is titled Regulating the Digital Economy. And it is with great honor and privilege that I welcome this year's keynote speaker, Commissioner Hester Peirce. She is popularly referred to as the crypto mom by the industry. She is very well versed in digital assets, cryptocurrency, blockchain, among the 5 commissioners. Commissioner Peirce was appointed by President Donald J. Trump to the U.S. Securities and Exchange Commission and was sworn in on January 11, 2018. Prior to joining the SEC, Commissioner Peirce conducted research on the regulation of financial markets at the Marketers Center at George Mason University. She was a senior counsel on the U.S. Senate Committee on Banking, Housing, and Urban Affairs, where she advised ranking members of the committee on securities issues. Commissioner Peirce served as counsel to the SEC Commissioner Paul S. Atkins. She's also worked as a staff attorney in the Division of Investment Management. Commissioner Peirce was an associate at Wilmer Cutler and Pickering, now Wilmer Hill, and clerked for Judge Roger Underwelt on the Court of Federal Claims. Commissioner Peirce earned her bachelor's degree in economics from Case Western Reserve University and her JD from the Yale Law School. It is with great honor that I welcome Commissioner Peirce. Thank you so much for being here with us today.
Rennie, it's a pleasure. Thank you for that kind introduction. And I'm just delighted to be with all of you today. I have to start out, of course, with my usual disclaimer that my views are my own and not necessarily those of the Securities and Exchange Commission or my fellow commissioners. The momentous market events of several weeks ago are relevant to the theme of this year's conference, which is regulating the digital economy, and thus motivate my remarks. The market events to which I'm referring are, of course, the Reddit-threaded run-up in the prices of a number of meme stocks, the subsequent rundown in prices, and the many attendant colorful stories. At the top of the non-financial news feed were the market volatility, trading volumes, regular Joe to riches stories, hedge fund losses, short squeezes, gamma squeezes, glee at sticking it to the suits, anger at trading limitation, a jumble of emotions as stock prices fell from their highs, and debates about the intricacies of market structure. Movies to elucidate these events are on their way. The SEC, of course, along with other regulators and market watchers, is still sorting through the many layers of these events. So I can't give you a definitive assessment of what took place, let alone whether any significant regulatory changes or enforcement actions will result. Instead, I want to offer you some musings on the challenges that lie before the Commission as we decide whether and how to react to these events with new or modified regulations, and more generally as we think about stepping up our game as regulator of the digital economy, or as one of the regulators of the digital economy. The digital economy enabled the past month's remarkable market events. Trading strategies crowdsourced in real time on widely available social media platforms, instant retail access to the capital markets through handy mobile trading apps, institutional high-frequency trading enabled by powerful computing and communications technology responding to and interacting with the retail flows, and sophisticated technology at trading venues and clearinghouses capable of handling record trading volumes. Add some primal emotions into the mix, and the regulator's job in the digital economy can be a very difficult one. Before turning to the challenges of regulating the digital economy, I think it's helpful to recognize that even as our markets undergo technological transformation, our jobs in many ways will remain much as they always have been. After all, the economy, whether analog or digital, is driven by people. Even regulators, at least until the robots replace us, are people. And people are with their swirling mix of rationality and emotions, are unique, interesting, and complicated. They're also fallible, frail, and often tempted to abuse power that they have. People respond to incentives. Any effective and fair regulatory framework has to start with a recognition and understanding of people. A book I read recently really brought home to me the constancy of people's peopleness. These events, like the ones of last month, featured a colorful cast of characters whose fortunes rose and fell and who made their way onto the big screen. The book tells the story of the uranium markets in the mid-20th century, the flames of which were stoked, choked, and revived by the changing policy of the US government's Atomic Energy Commission. The book's principal author had a bad case of uranium fever, which led him to engage in all sorts of daring adventures to stake uranium claims in the Western desert and to raise money to finance them. He describes to his wife, as she lies in the hospital recovering from an operation, his plans to sell claims to the public and what he explains might be a real estate deal, a security deal, something similar to an oil lease, or maybe something else. His wife raises the possibility of jail time, which the author takes as evidence that he should have known better than to talk business with my wife. She never has the positive thinking attitude. His other family members, however, were more positive thinking. One brother explained, "I've already got blue chip stock, I've got gilt edge bonds, I've got my house and car paid for, I've got insurance. If I'd wanted to invest, I know where I could have put my dough. But this was a gamble. I don't want another sure thing. I want to go for the big bundle." That, the author explained, showed that his family had the fever. Make it or lose it, but nothing safe, sound, and secure. You may find this hard to believe, but I promise you I didn't pull these lines off Reddit. A lot of other people had the fever too, and the author found them through a mailing campaign, and he got them to send him money. This is what he said. In mailing, I'd aimed at ordinary Joes, not the professional class, not the ones who were constantly being approached with the deals. I wanted the little people who might never again in their lives have a chance to go for the big bundle for $10 down. And the little people liked my deal. The author reminisces about the big boom in penny uranium stocks, during which everyone in the frantic game of trading penny stocks knew that most of them were wallpaper, but that one of them, which one you didn't know, would be struck by lightning. So buy, and wait for that thunderbolt from the blue. He further observed that when a company admitted that it didn't own its own claims and there was absolutely no evidence of uranium, the public rushed to buy stock from such honest people. The boom went bust when the Atomic Energy Commission pulled its support from further uranium production. That didn't trouble the author too much. There'd be another deal, except for the stockholders. I'd used other people's money. The book, despite a labyrinth of detours into wholly unrelated and often unwelcome topics, contains many other insights into investor psychology, but I think you get the point. People love participating in hot markets. They often do so with eyes wide open to the potential for losses and fingers crossed for big gains. And frequently, they lose real money in the process. And it's not always money that they can afford to lose. Because the human participants in the digital economy are people, some aspects of regulating the digital economy look a lot like regulating any other kind of economy. One of our regulatory obligations that doesn't change much with the times, for example, is that while we respect people's right and capacity to make their own decisions, we do remind people of some basic truths about participating in the markets. The medium may change, but the message is the same. The Commission has an Office of Investor Education and Advocacy. They issued an investor alert at the end of January to help investors understand the significant risks of short-term trading based on social media. The alert contained tips that also would have been very helpful for the uranium investors of last century, including a warning about the rapid rise in the price of an investment, reflecting a high degree of collective enthusiasm or exuberance regarding the investment's prospects that's usually followed by a wide-scale selling of the investment that causes a sharp decline in the investment's price, and reminders that you should never feel pressured to invest right away and that you should not let short-term emotions about investments disrupt your long-term financial objectives. Although the Commission's delivery method has changed with the times, our investor empowerment message is pretty much the same in the digital world as it was before the digital era. Mr. Taylor's uranium investors would have benefited from such a message as much as today's investors. So too, our role in policing the markets for fraud hasn't changed much. As in the past, People often use lies to induce buys, and we bring a lot of enforcement actions to pursue those fraudsters. Although the means of disseminating the lies are digital, the nature of the conduct isn't new. The projects for which funds are being raised may be crypto mining rather than uranium mining, but the fraudsters' plans for the funds raised are generally the same as always: a nice house, fine dining, private school tuition, and maybe even some plastic surgery just in case there's a parallel criminal action and an attendant mugshot. Digital economy regulators are also susceptible to some of the same incentives and temptations that regulators have always faced. Unchanged in the digital world is our obligation to balance our enforcement mission with the need to respect American civil liberties. We may have new digital tools that make it easier than ever to find bad actors, but they also make it easier to trample over individual rights while doing so. As we put these tools to work for us, we need to bear in mind that when the government watches too much of what a free people do, those people are no longer free. We have greater and faster insight into trading activity now. We can store massive amounts of data. We have computing power and sophisticated software to analyze and work with the data we collect. Technology enables us to examine individual registered entities remotely rather than through in-person visits. Structured data allows us to analyze particular registrants or look for trends or patterns across many registrants with the click of a button. We have access to effective blockchain analytics, and we have people expert in the use of these tools and the data they generate. One day, we may even have easily machine-readable rule books, which will foster compliance by regulated entities. Our regulatory mission will remain the same even as technological developments bring new ways for the capital markets to achieve their core objectives: capital formation and investor enrichment. That means essentially that the goal of our markets is facilitating the flow of investor money to real companies so that those companies can then serve other people's needs and then return the money to investors so that they in turn can build wealth for themselves, their families, and their communities. Technology has the potential to turbocharge the capital markets' ability to achieve this objective. When I say technological turbocharging, I don't mean speeding up this virtuous cycle. What I mean is that technology facilitates, what I mean is instead that technology can be used to improve this virtuous cycle. We don't want technology that facilitates unpredictable volatility because that can undermine the market's ability to do what they're supposed to do. Building companies into societally beneficial ventures and building investment nest eggs are slow processes that demand patience, deliberation, and self-discipline. Technology can help markets to deploy capital well, in part by encouraging more of the population to benefit both from contributing capital and using capital to build companies. But technology doesn't change our regulatory objectives of protecting investors, facilitating capital formation, and fostering market integrity. For technology to have its maximum benefit, we really need to change our attitude. Specifically, we tend to look at technological innovation in the markets with deep suspicion, and that mindset really has to change. Attempts to create a good experience using an attractive, easy to navigate interface run headlong into our dusty set of regulations written with paper, and we have snail mail, paper, and precise legalese in mind. We've designed these rules to provide us with static records that are easy to examine, rather than to provide actual investors with the information they need in a format that they can digest. Investors, conditioned by their experience with companies in all other sectors, expect more, and our rules should not prevent financial institutions from meeting those expectations. As one commentator explained, regulators ought not to complain when, quote, online broker-dealers provide an attractive user experience, just as other tech firms do. Embracing rather than frowning upon technology is the only way to achieve our objective of ensuring that investors receive, absorb, and take into account the information that they need to make wise investment decisions. Another part of ensuring that we're not hamstringing the ability of technology to make markets work better for more people is remembering that our role is to protect investors and markets, not incumbents. Incumbent firms, by definition, have adapted themselves well to the existing regulatory framework and to the existing market infrastructure and to establish technological tools. They may be slower to adopt new technology. Indeed, it may not be in their interest to do so. Resisting regulatory changes that would permit new ways of doing business or insisting on regulatory changes to forestall technological innovation may be a matter of life or death for some of these legacy firms. We regulators should refuse to allow ourselves to be used to block new firms from coming into the industry with fresh new ways of doing things. We must do what's best for investors and markets. Decentralized finance will provide a very good test for our ability to regulate with an eye toward protecting the interests of investors and markets rather than incumbents. The anti-Wall Street sentiments coursing through the market events of recent weeks and the growing realization of the power that private and public centralized entities wield in our lives have inspired some to call for throwing the legacy financial system out entirely. In its place, they would put decentralized finance, or commonly known as DeFi. The nascent DeFi industry is a rapidly growing corner of the crypto world, and there's significant money now locked up in DeFi. And it's working on building an alternative to the legacy centralized financial system, which we can call CeFi. And the DeFi system is run through smart contracts rather than financial intermediaries. DeFi facilitates lending, trading, and investing in crypto assets. DeFi users trust in smart contracts rather than central counterparties. Although a work in progress with all of the growing pains and rough edges that implies, DeFi's promises of democratization, open access, transparency, predictability, and systemic resilience are alluring. Recently, the Federal Reserve Bank of St. Louis published a primer on the complicated and multi-layered world of DeFi. And that primer warns of risks, including security vulnerabilities, scaling problems, and faux decentralization. But it concludes that there is promise in the innovation that's happening in DeFi. So we regulators, we have to be mindful of the potential upsides and downsides, but we do need to provide legal clarity and the freedom to experiment so that DeFi can compete with CeFi to offer investors financial services. So what do all of these principles for regulators in the digital era mean for how we will respond to the events of the last several weeks? Some of the sentiment driving the meme stock events seem to have been rooted in a suspicion that the markets are not for everyone, but that their purpose is to serve only wealthy individuals and institutions. Some participants seem to have viewed these price rallies and attendant short and gamma squeezes as a way to serve Wall Street a poisonous meal of its own making. Popular antipathy toward Wall Street, fueled by bailouts and the financial crisis of 2007 to 2009, is still raw, and it's been aggravated by ongoing government policies that are viewed as disproportionately benefiting large asset holders now in exchange for an inflationary tab in the future that will hit working Americans without a lot of assets the hardest. As securities regulators, we can't address those fundamental concerns directly, but we do need to be looking for ways to ensure that the markets are working for everyone. Technology is already being used to draw new investors into the markets and to bring capital to companies and entrepreneurs for whom capital raising has until now been quite difficult. Increased participation in our markets is beneficial for the markets themselves, because, as one commentator explained, it creates a number of atomized agents providing hopefully unique stimuli and insights to create a more effective and efficient market. We need to be open to technological improvements that make the markets work better and encourage and equip more people to participate in them. Some commenters have criticized broker-dealers for making investing too easy, or even worse, too much fun. And fun doesn't necessarily sit well with securities regulators either. Of course, an appealing user interface isn't a substitute for ensuring that investors have access to the information that they need to invest wisely in light of their objectives and circumstances. But that same technology that makes investing fun can be used to educate and inform. Indeed, as one commentary on the GameStop event suggested, regulators should be using these same technologies to reach and teach retail investors. I apologize. So I'm having some issues with my computer, but I will get back on track here. This is the downside of doing something from a computer instead of doing it in person, which I certainly wish that we could be, but at least along the lines of this conference, it's good we have this technology so we can do it this way. We do need to be more proactive in embracing technology to address some of the concerns that the events of the past month have brought to light. The market machinery did work extremely well under the weight of record trading and high volatility, even in the work from home COVID world. Additional integration of technology, though, into all aspects of the post-trade process might make the system work even better. Trading in the digital economy is really fast, but the process for settling trades isn't. And that's come to light in the past few months, in the past few weeks here. There's been a lot of attention on that, specifically on the settlement date. So until 2017, settlement didn't occur until 3 days after the trade date, and that's commonly known as T+3. A regulatory change in 2017 brought that settlement cycle down to T+2. As many people have been discussing in recent days, there's thought about whether it would be better if we shortened that settlement cycle to T+1 or T+0. And the idea is that could yield additional benefits. It would lower risk associated with open positions and reduce collateral requirements. That was actually a topic in last week's congressional hearing. The CEO of Robinhood actually went so far as to call for real-time settlement, which is, immediate, and we see that working pretty well in the crypto world. Crypto transactions do settle quite quickly, and they settle effectively without a central counterparty. Smart contracts and distributed ledger technology could make that entire clearing and settlement process in the equity markets faster and more efficient also. And so I think it's important for us to consider what technology can do to change the settlement process to make it shorter. But we do need to think about whether real-time settlement is, if it is possible, whether it's the right solution. We really need to look at the costs and benefits of that. Real-time settlement would certainly address many of the concerns that we saw around the events of last month in terms of collateral calls and questions about clearing and what clearing houses are asking of broker dealers. But there are also some definite concerns about how adoption of real-time or at least near real-time settlement of transactions in the equity markets would affect those markets. They would probably require a major overhaul in the way that the equity markets work, and they could harm liquidity by raising the cost of making markets. Certain elements of our financial system as it's currently structured work precisely because of the delay between execution and settlement. An expected drop in margin requirements from shortening the settlement cycle might not make up for the inability to net transactions, much less the operational risks and ensuing costs of settling transactions on a gross basis and then transferring large amounts of cash and securities throughout the day. In addition, the time built into the settlement cycle now makes error correction easier and allows for human intervention, a feature that a smart contract is designed to eliminate. The bottom line is that a less ambitious approach that focuses less on the immediately exciting technological improvements and focuses instead on modernizing the post-trade settlement process by eliminating some of the antiquated features of it, such as intensely manual processing and non-standard practices across different participants in the market. That might be a way for us to make incremental progress, but still meaningful progress. Another use for technology that we're thinking of, or that I'm thinking of in light of the events of the past several weeks, is better transparency. many retail investors, for example, are now using commission-free trading. And this is something that broker-dealers are able to offer to their customers because they're getting payment for order flow from market makers who like to engage with those retail orders. This practice likely has been a net benefit to retail investors. It has reduced the cost of making a trade and often results in a small improvement of their execution price over the official NBBO, we call it, the National Best Bid or Offer. But at the same time, critics are correct when they point out the potential for conflicts of interest on the part of the broker, who may be tempted to send trades to a market maker that offers worse execution pricing. That hurts the investor, but then better payment for order flow, which benefits the broker. The way to address this potential conflict is not to ban the practice, which would eliminate the conflict at the cost of a likely increase in cost to the investor, but rather to require better disclosure. And that's where technology can come in. As the cost of data processing, presentation, and delivery continues to plummet, we can use that technology to ensure that investors receive accurate disclosures about not only about the practices that they occur, but also to give them a better sense of what the effect is on the quality of execution of their trades. So in closing, whether we're talking about trading uranium claims for the atomic energy of the past, building communities of atomized retail investors on social media today, or enabling atomic swaps in the DeFi of the future, people's ingenuity and enthusiasm keep us regulators on our toes. In many ways, the regulator's job is unchanged, even though the stage is set with more modern scenery. The digital economy does pose some new regulatory challenges, but it also gives us new tools to meet those challenges. We should use those tools with genuine care for the freedom of the people we regulate. We should welcome the new technology's potential to improve the way markets work and to make them work for more people. The payoff is high. A successful regulatory framework for the digital economy will unleash its ability to empower individuals to build better futures for themselves, their families, and their communities. Thank you, and I'd be happy to take some questions.
Thank you for that very interesting speech and analogy that you've given on the SEC's position. And I completely agree with you on the role of the commission, which is to protect investors primarily and not incumbents. And so that will take me to my first question for you, Ms. Commissioner, which is, for now, Bitcoin is considered is treated as a financial asset, at least in the US. And I want to know what your thoughts are, since Tesla, for instance, has announced that it would be accepting Bitcoin as a form of payment. And what risk do you think that will pose, if any, to the traditional use of fiat currency? And what is the SEC's position on that proposal by Tesla? Or what are your thoughts on that proposal?
Sure. Well, I should say that is a little bit outside of our purview as securities regulators. Thinking about what kind of payment companies are going to get. Of course, that's something that any company that's planning to accept payment in Bitcoin probably has to, depending on how material the amounts that it's going to receive. I mean, if no one takes them up on that, then maybe not. And again, I'm not talking about any specific company. I want to take this out of the context of any specific company and just make the point that if you're accepting Bitcoin for payment, and that's actually going to become an important way for you to get paid, you probably have to think about what the risks are associated with that. Bitcoin is volatile. As we've seen recently, it's been going up quite a bit. It can also go down quite a bit. And so those are the kinds of things that companies need to think about. I think one of the other interesting phenomena that's occurring is that some companies are deciding to put some of their treasury reserves into Bitcoin. And that also is quite a change. And I think that ties to one of the themes that I spoke about, which is that people are looking at the policies that the government is using today, and they're saying, well, some of these look quite inflationary. And so is there an asset apart from the dollar that we can use to maybe guard against inflation? And so people are thinking about Bitcoin in new ways. Some people completely disagree with that view of the purpose or function of Bitcoin. So, it's a market and people can all express their ideas, but I think we're seeing some people put their ideas into action by putting Bitcoin on their balance sheet.
Yes, and I recently also looked at your safe harbor proposal, which you mentioned that Bitcoin issuers can perhaps after 3 years, the commission would determine if it's a security, if the crypto asset is a security or not. And I'm curious to learn what that would look like if eventually crypto assets are now treated as a currency. For instance, we've seen China issue its own digital currency, government issued digital currency. Do we see the US moving in the same direction or far from it, or leaving it into the hands of private individuals, private members, basically, and not from a government standpoint? And so how would that be regulated from the Commission's standpoint?
Well, so I think what your question highlights is there are a lot of different potential regulatory reaches into crypto, and the SEC is one of those. The CFTC, the Commodity Futures Trading Commission, is another. And then the Fed also has a lot to say, and the bank regulators have a lot to say, both at the state and federal level. So there are many questions to be answered. With a central bank digital currency, which, as you said, China is moving forward in that regard, I think that the United States is likely at some point to move forward in that regard. Certainly that's the Fed's domain, not mine. But I think as Chris Giancarlo, who was the head of the CFTC and is now working on a project to try to get the SEC to move forward on a central bank digital currency, he kind of describes it as being good infrastructure, right? We're moving to a world where it's a digital world, and it's likely that people are going to want our currency to be able to live in this digital world more seamlessly than it does now. And so you can imagine that. I think the big issue with central bank digital currencies that has to be addressed is privacy. We certainly don't want the government knowing everything that we spend all of our money on. And again, that's not because we're doing illegal things. It's just you don't really like to have someone, I don't really like to have someone know how much chocolate I buy from the grocery store or whatever it might be. So that issue is one that we'll have to grapple with. I think it's going to be easier for us to make a credible privacy case than it might be for some other countries like China. In terms of the safe harbor, so I proposed a safe harbor to allow people to do token distribution events, which is something that is quite difficult to do in the United States because our securities laws have this very broad definition of what it is to be a security. So obviously a stock or a bond would fit into the category of security, but if you're raising money for something in a slightly non-conventional way, perhaps then that contract that you're selling might actually be an investment contract and a security under our laws. And so when people sell a token and they make a lot of promises about all of the efforts they're going to put into that token network growing and developing and the token appreciating in price, the SEC has come in and said, well, that looks a lot like a securities offering to us, and so we're going to treat it that way. I've disagreed with some of the individual instances of where we've applied that logic, but I agree that because that investment contract definition is quite broad, it can be ambiguous. And so the idea of the safe harbor was to provide this 3-year period during which you wouldn't have to prove one way or the other. You would provide the purchasers of tokens some of the same kinds of disclosures that the securities laws demand, but tailored in a way so that it makes more sense for the kind of information a token purchaser would want. And then you've got 3 years to build out your network. So presumably you've done some work on the front end before you do this token distribution event. That you've probably funded with venture capital or some other kind of capital. Then you do this token distribution event. You've got 3 years to build out your network, and then after that point, you're kind of freed, and that token is now coin of the realm on the network, but it's not something that we would regulate. There's no central party who has more information than everyone else, because this is truly a decentralized network, or the token is really has a use case, at which point it doesn't look like a security.
Yes, that's a very great proposal, and I know that it's going to evolve as we see the crypto world also evolve. My next question is going to focus on, so currently now, there are a lot of anti-money laundering issues that has been going on about the use of cryptocurrency and how it's used to fund terrorism. So what my question is do you agree? What do you think about the ongoing message or comments that cryptocurrencies is a movement to enable money laundering? And what are your thoughts or position on that?
So I think no matter what people build for good, some people are going to use it for bad things. That's what we've seen in history, and certainly true with money. So that's true with cash. People use cash for a lot of bad purposes, and people use it for good purposes. And so you've got to kind of accept that if you have something, if you have a money, some people might use it for bad things. I think the myth about Bitcoin and crypto being used primarily for illegal activity was born quite a while ago, with Silk Road, for example, which was an online market for drugs and other things. Crypto was being used there. But actually, the percentages now of crypto that are used for illegal activity are believed to be quite low. And one of the reasons for that is that there are very sophisticated analytics firms that are now able to go back and figure out, who's behind what. So using a distributed ledger type based cryptocurrency may not actually be the best way for these criminals and terrorists to do things. So that has sort of dissuaded, I think, people from doing it. Now, that said, we have anti-money laundering and know your customer rules in the United States under the Bank Secrecy Act, and those are applied to the crypto world as they are applied to the traditional financial world, and I don't expect that to change. In fact, we saw recently at the end of 2020, FinCEN, which is the office within Treasury that deals with the BSA, they came out with a proposal which garnered a lot of commentary, much of it negative, but it did put out there the notion that yes, this is something that FinCEN is looking at. They had obviously already been working on it, but this was kind of the next step. And so clearly it's something that FinCEN is thinking about quite carefully.
Yes, thank you for your comments on that. And I wasn't planning to ask this question, but it just follows from what we just discussed, what you just mentioned now. I'm Nigerian. I don't know if you're aware of that, but recently, my country, Nigeria, the Nigerian government banned the use of cryptocurrency, crypto assets in Nigeria, and they required deposit monetary banks to close any bank accounts, customer bank accounts that engages in any sale of crypto assets. And the justification for this was because they believed it's a significant tool in the hands of terror, for financing terrorists and money laundering activities, and that was their sole justification for imposing this ban. However, I don't know if you were aware, at some point in October last year, there was a protest which was against the use of police force on citizens. And so there were a lot of fundraising activities going on with that, along with that protest. And so the government were sort of against the funding for the protest. And so they blocked all Nigerian bank accounts that were used in some way to sponsor the protest, which was primarily used to feed the protesters, give them water, and make sure that they're safe and protected. And so the protesters resorted to the use of Bitcoin. And so instead of sending money, donating funds to a Nigerian bank account, they will ask you to buy Bitcoin and sell it to them. Or so that was one way the protesters were able to raise significant amount of money to fund their activities. And so a lot of people think it's either that's probably one of the reasons they're issuing this ban, although the central bank says it's not, because they've issued this ban in 2017 before, but now they're being proactive about enforcing it. So, but my question is, do you think that it's a justified reason to ban crypto assets in the country, or what should governments just generally be aware of or do in that situation?
Well, it's certainly an important development, and one that I think a lot of people in the crypto world are talking about, because Nigeria is such a large country with quite a bit of interest in crypto. So it's a meaningful change because of that. I think one point that that I've made in the past is that it's very difficult to ban Bitcoin or other kinds of crypto, because banning Bitcoin requires you to shut down the internet everywhere, and people are very creative and they can find ways to do things. What I would say in general for countries thinking about these kinds of issues is the best way to have some insight and some ability to impose know your customer anti-money laundering kind of controls is if you have some link with the traditional legacy financial system, and that means banks, because as banks interact with different counterparties, they have to think about that. And so that is usually a more direct way to get some insight into what's going on.
Great, thank you so much. So, okay, another comment or theme that has been going around recently is that digital currencies is another way to solve the issues of financial inclusion, because of its ability to attract non-users of bank accounts, users who do not own bank accounts. So my question is this a feasible solution? Do you really see this as a solution? Or are there other reasons why it might not necessarily be solving financial inclusion per se?
Well, I don't think there's one simple solution to financial inclusion, but I do think that there are real benefits to a technology that's very much, one of the things I mentioned in my talk was that DeFi, for example, is run on smart contracts, and a smart contract will interact with you based on the collateral requirements or whatever the requirements are, and that's just how it works. And so it's a very easy way for people to come in kind of into the system and not worry about the human element to the extent there's discrimination or anything like that. It just doesn't come into play. But I think we've seen that crypto has been very useful in certain countries where people have been excluded from the financial system before. Now they're not only included in the financial system, but in the global financial system, which means that they can contribute their time and talents to things and get paid, and no one has to know. And so I think that's a really powerful change agent for example, women who might otherwise be unable to work in certain countries, or might want to build a nest egg so that they can leave an abusive situation or something like that. So I think there is real promise there. And certainly in the United States, I think there's real promise in people using crypto to build their own financial futures. As I mentioned also in the talk, the capital markets are really intended to bring together investors and companies looking for companies that are looking for capital, investors who have capital to invest. And we need to do a better job getting people integrated into that traditional financial system as well, because there's such power, not only if you're building a company and being able to draw capital from that system and build your company, which has a huge effect on your community and then on your ability to secure your financial future, but also for investors. We really want to get the numbers of investors in our financial system up. We want more American households to be participating and building their nest egg so they can pass it on. I think there's real power to having not only enough to retire on, but some to pass on to your children, so that then they have a little bit of a safety net when they decide they want to go to Paris for a year and explore the art world in Paris. They have that safety net that they can do that. Or if you want to give your kids something so they can put a down payment on a house or along those lines, I think it's really valuable to get people participating both in the traditional financial system and in the crypto world. And I think that will make us all a stronger community where there's a little bit more of a safety net built in at the family level also.
Absolutely, and I couldn't agree with you more. And that's really one of the main critics as to why would the government in Nigeria, for instance, shut down the use of cryptocurrency or ban it, when a lot of people are actually relying on it as a significant source of income and in trading the assets. And that's, like you mentioned, the privacy it gives to women and others who can make this money and build this wealth without necessarily being, noticed. And just I personally feel it's that's sort of nuanced area where they're not really sure what it is and still trying to grapple with if it's good for our economy or our naira or not. And some work needs to be done definitely on that.
I mean, for me, a bottom line is that if people are trying to engage in voluntary transactions that are truly voluntary on both sides, the default position for a government should be that's fine for people to do, because they know their own situations better than we know at the regulatory level. I mean, they know the challenges they're facing, they know the talents they have and the opportunities that they would have too. And so they're smarter about their lives than we are. So we really need to give people the opportunity to explore things. Of course, we have, investor protection is our mandate at the SEC, but that doesn't mean that we put ourselves in the place of making decisions for other people if we really don't have to do that.
Yes, thank you so much. And I have another question for you. So currently, I don't know if you're probably aware of this recent prosecution or conviction of North Korean actors that were hijacking crypto as private keys and stealing private keys, hijacking private owners, crypto assets. And so my question is, what does that risk? I'm trying to find it, sorry. Okay, yes. So what is the prosecution of North Korean officials hacking and stealing about $1.3 billion from US banks and US-based crypto exchanges? What does this new prosecution tell us about the safety or security of cryptocurrency, and how do you think the commission should protect retail investors from that potential risk?
Well, I can't speak to that specific event, but this is a reality of our digital lives now, that cybersecurity concerns for individuals, for companies, for regulators. Those are all very real concerns, and it's a constant struggle for all of us. And I think it's something where everyone needs to be working together to come up with best practices, to figure out solutions, to identify people who are doing illegal acts with respect to hacking and those sorts of things. One of the things that I like to emphasize is that, there's been a lot of pressure on the SEC to either, say what's covered by the securities laws and what's not. And so one of the things that most people believe is not covered by the securities laws is spot exchanges in crypto. So a trading platform that trades crypto assets that are not securities would not fall under our purview. But sometimes when something bad happens at one of those platforms, people will come to us and say, well, something bad happened, can you help me? And my response is, you can't have it. I mean, my heart goes out to you for having lost money, but you can't have it both ways. We can't both not be a regulator and then be expected to regulate to stop the bad activities. I will say that I think that the spot markets, we're seeing kind of who takes this stuff seriously and who doesn't. And so I think that consumers will be walking away from the exchanges that they feel are not protecting them and walking to ones that they feel have good protections in place. But all of this stuff is very difficult. The hackers are very sophisticated, and so it is a real challenge.
Agreeable, and it's not a necessary risk that we see when trading normal securities. So it also brings the question of, is it really a security in that sense or not?
Well, I do think it's important for people to remember that even on the traditional security side, there are a lot of bad actors out there who are trying to take advantage of you, trying to do account intrusions and those kinds of things. And so good security practices are very important in the traditional securities markets as well, especially as securities firms and asset managers, broker dealers, in dealing with customers are trying to meet customers where they are, which is really on these in the digital world, on their mobile phones, and in ways that they don't want to be getting these big paper prospectuses in the mail. They want to get everything via email or text, and so that's a real challenge too on the security side, to make sure that they can both provide all of that optionality for investors, but also provide them the protection that they expect.
Okay, and my final question, which is, let me see. Okay, it's a bit long, but I'm just going to save it for later because I know we're a bit out of time and we have some questions coming in. Do you own any cryptocurrency currently?
I do not. In my role, I'm not allowed to hold crypto assets, so I don't.
Okay, and before I turn it over to Abraham, who is going to help us moderate the questions from the panel, from the attendees, what final advice or comments do you have for our students who are very eager and watching you right now?
Well, my big piece of advice is, you're at a really exciting time of your lives and your careers, and so revel in that excitement. The world is your oyster. You can go and think about doing lots of different kinds of things in lots of different kinds of places, and you should take advantage of that. Don't always be thinking about building your resume, be thinking about what you enjoy. And I think a really important point to underscore is that each one of you has such has a unique set of talents and experiences and ideas. And so there's one you, and you really need to enjoy being that one you, and don't worry about what other people are doing. You've got to figure out what it is that you can contribute to society, and what will then in turn make you more joyful as a person. And so don't look around at other people. Just figure out what it is you like to do, what you're good at doing, and there's a place just for you that nobody else can fill.
Said like a true mom. Thank you so much. And it's a pleasure having you here. Now, I'd like to invite Abraham, who is the chair of the Business and Finance Law Committee, who would read out the questions from the attendees and direct that for you. Thank you so much.
Hi, so our first question is actually going to be from one of our panelists this afternoon, Carol Van Cleef, who said, we heard yesterday from reliable sources that key regulatory agencies are working hard through the weekend on the issue of stablecoins. Is that effort focused more on regulatory or legislative action?
Well, again, I'm not sure what the question is referring to precisely, but I think stablecoins have been quite the topic of the last year or so, and probably more than that now. It certainly got a lot of attention when Libra came to light, which is now has a new name, but it's now called Diem, and that attracted a lot of attention from regulators and governments all over the world. And there are a lot of other stablecoins that have gotten quite widespread acceptance and are being used widely. Part of that is because the DeFi movement that I talked about in my remarks has really grown exponentially in the last well, since summer of 2020. And so stablecoins play a role in the DeFi world. So I think there's a lot of attention from the securities regulator perspective. A lot of stablecoin issues are really outside of our purview, but we always encourage people to come talk to us because some stablecoins may be designed in a way that they are securities-like, and if that's the case, then we obviously will weigh in.
All right, also, you recently stated at the GBBC and GDF Global Leaders Series that the SEC needed to provide additional clarity regarding digital asset-backed ETPs. Specifically, you mentioned that digital asset-backed ETPs are judged by different standards than regular ETPs in some respects. Can you further elaborate on anything the SEC is considering to finally allow digital asset-backed ETPs?
Well, that has been the question number one since day one of my job, is when's the SEC going to approve one of these exchange traded products that has an underlier such as Bitcoin or ETH. And we have considered a number of them during my time at the SEC. I've issued a couple dissents to say, along the lines of your question, that the standards that we've applied, I think, have been different. We've taken a much deeper interest in the workings of the underlying markets, the spot markets for Bitcoin. And we've asked a ton of questions. And to some extent, I feel that the goalpost has moved throughout those discussions. So now we've gotten some new applications in. We consider all of them on their facts and circumstances, so I can't speak to any of the specific ones. But we are getting a new chairman here likely in the next months or weeks, or I don't know. Assuming that Gensler gets confirmed, Chairman Gensler will come in. He comes in with quite a bit of experience in the crypto world. He knows this area, and so whether or not we'll be able to take a fresh look, I'm hopeful that we will.
All right, at this point, also, I'd like to say that if anybody else has any questions, to please put them in through the Q&A system. I'm also able to see questions from the YouTube live stream if you're watching through there as well. Another question we have is, what are your opinions on, I'm just going to scroll through to it, on the Wyoming's Special Purpose Depository Institution Charter?
So Wyoming has been really out front in terms of thinking about regulating crypto and building a very crypto-friendly environment. Part of what a crypto-friendly environment requires is a good regulatory structure that provides regulatory clarity. And so that state actually set out to build something specific for crypto. And one piece of that is the SPDI, the Special Purpose Depository Institution. which is designed to be a crypto entity. And I think that that's a very positive development, just in terms of being an example for us of how we might think about building specific rules for crypto. There's also a potential interaction between some of what Wyoming is doing and some of what the SEC is doing. So Wyoming, for example, recently issued a no action letter to an entity in Wyoming that they deem to be a qualified custodian under our Investment Advisors Act. So we then put out a letter, the staff of the SEC put out a letter saying, hold on, that's our decision that's really our area to think about. But I think it's good that Wyoming is pushing us to think about that issue. And I encourage anyone who is interested in that issue to please write in and comment. We put out a number of questions in that statement, and I sometimes get disappointed because not as many people write in response and provide us input, and it's harder to have a good conversation if we don't get good input. And for those of you who are students, these are some issues that you can think about writing law review articles on. I think it's, or papers. I mean, I think it's really a fascinating area. This whole area is a fascinating one for scholarship. There's a lot to be rethought.
Thank you. What do you think of what do you think the GameStop event reflects on the shorting practice by institutional firms? And after the support that the Reddit investors got, do you think it is time to address some of those practices such as shorting by large institutional firms?
I think it's important to remember that short selling plays several very valuable functions in our market. So it is a way for people to get rewarded for doing work, to find out things about a company that might not otherwise come to light. And so short sellers can actually be some of the first people to identify fraud at a company, for example, because they can do the work and then they can short and they can get rewarded monetarily for doing that work. So that's an important function. Another important function is that short selling, having short selling available as an option for people helps the market to be more liquid. It's easier for a market maker, someone to be there whenever you want to buy or sell a security, if that person can short to hedge its own risk. And so if you take that away, that makes it harder it makes the market less liquid and ultimately can actually drive prices of securities down. There's research that shows where short selling is available, securities prices are actually higher. And then another function that it plays is there's a process for making markets in exchange traded funds and for playing a role there, and short selling can help there. So there are lots of areas where short selling can be helpful. Of course, there's some tactics employed by some short sellers that are not okay, and those are, for example, if you just try to put out bad information in order to drive the price down so that you can make a lot of money on your short. But those are kinds of issues that we can already address with existing rules and laws that we have. Now, there have been calls for more transparency around shorting, and those are things that I think we'll have some conversations about in the upcoming months. I think we have to get the balance right, because again, short selling does play this valuable role, and so you want to make sure that you're not making it unprofitable to short sell by putting in transparency measures. But again, those things have to be considered in the context of what the actual restrictions or disclosure requirements are around short selling. And I should mention too that there are rules around naked short selling. You're not allowed to engage in that generally. You have to actually borrow a share or locate that share for a borrow before you engage in short selling. And so again, we can look at the rules around that and make sure they're working as they should be.
Do you have any views on special purpose acquisition companies? Is there a way to support their positive traits and inhibit their speculative negative traits at the same time?
Well, it is an interesting development. So special purpose acquisition companies are companies that they're public, but they're basically a shell company looking to merge with a private company and thereby take that private company public. So it's a different route for a private company to go public. And they used to be used quite a bit, and then they went out of fashion for a while, and so now they're back in fashion. Definitely, they're being used quite a bit these days. And so there are questions. Of course, people are looking at a lot of aspects of SPACs to make sure that they're being transparent with investors, so investors understand what the terms are, what the promoters of the SPAC get versus what other investors get. So transparency is really important. But I think that the rise in SPACs also raises some questions about, is our traditional IPO process becoming too expensive, or is it not working the way it should? We should be asking those kinds of questions too. But I think it's on the whole positive to have a lot of different options available for companies that are thinking about going public to actually do that. So on the whole, I think it's positive, but we certainly need to make sure there's good disclosure that gives investors what they need to know.
I've gotten this one a few times. Are you able to share the name of the book that you talked about discussing uranium?
The name I don't remember, but it will be in the footnotes to my speech. So it's written by two brothers whose last name is Taylor. It's a fascinating book. I'm not sure how easy it is to come by.
What are your thoughts on the extent that simple agreement for future tokens are subject to security laws?
Well, the SAFT itself. So if you tell people, look, we want to raise money from you in order to build out this project, and you do that at a very early phase, I think there's a very big likelihood that what you're doing is you're just raising money, and that's a capital raise like anything else. And so what a lot of people have done is at that SAFT stage, they have that is a securities offering that they've only offered to, for example, accredited investors. So it's not a public offering. But the question then becomes, is the token the security? And if it is, then how do you ever do a token distribution event without having it be a securities offering? And that's the piece of the puzzle that I would like to address. So if, go ahead and treat that initial SAFT event as a securities offering, and limit that to, do that in the private markets. And then when you want to do the token offering, let's not think about the token itself as being the security.
Thank you. Treasury Secretary Yellen recently spoke of the concern that cryptocurrencies may be used for illicit transactions and criminal activities. Do you anticipate any regulatory policies and changes in this area?
Well, I think we all share that concern, and so I think that will be a concern throughout the life of any kind of payment mechanism, right? That people could use it for ill purposes. But I think where the attention is likely, where that concern is likely to be manifested is in additional rules coming out of FinCEN around BSA, Bank Secrecy Act type rules, so that as there are, as traditional financial institutions engage with crypto, there will be rules around that, and that's kind of what those rules that were proposed at the end of the year were designed to do. Although they ended up, going much further, and a lot of people pushed back on how far they went. So I think that that's something that we need to think about. And then just a theme that I think it's important for all of us to think about is there's always a balance between allowing something to go forward and putting constraints around it. But we do have to think of the importance of the ability for people who are not suspected of wrongdoing to transact without undue surveillance. And so that's a balance we always should be bearing in mind and thinking about.
Thank you. In light of the recent rise in popularity of Bitcoin and China's digital currency, what are your current views on DM?
I think I would be wise not to speak specifically about any particular project. I think in general, Libra, when it started out as Libra, was helpful in getting people to think about this part of the world, about the crypto part of the world. Granted, not all of the immediate reactions were positive, but I think it is helpful to be having this conversation, and I think it helped to move that conversation forward. It's not clear to me whether DM, or any other stablecoin. I think you have to look at the specifics. So you have to look at whether or not it has aspects that are security-based aspects in which my opinion would matter. Otherwise, it doesn't really matter on what it might be or how it should be regulated.
And last question I have so far, so if there are any others, please submit them soon, is from a member of the committee organizing last year's conference, asking, do you have any new insights regarding factors the SEC is considering when deciding to allow a new digital asset-backed security exchange traded product? Discussed it a little bit earlier, but.
Yeah, I think what has changed since we considered those applications last year and the year before, losing track of time, maybe it was even the year before that. But anyway, the industry has moved quite a lot since those prior applications were considered. And there's a lot more institutional interest in Bitcoin and Ethereum. And so I think that has changed the reality for us, which is that a lot of people are looking for ways to interact with Bitcoin and other crypto through our regulated securities markets. That was a point I made in my dissent, but I think it's even stronger now because there's even more institutional interest. We talked about some companies putting Bitcoin on their balance sheets. Some investors looking to have exposure to Bitcoin might think, well, the only way I can get exposure is to buy a public company that has Bitcoin on its balance sheet. And at that point, then the question is, well, why shouldn't we allow people to do that through an exchange traded product that's really created for that purpose? We have some over-the-counter products now that give people the possibility of getting exposure, but those tend to trade at a premium. So maybe it would make more sense just to allow an on-exchange product where people wouldn't have to pay those kinds of premiums. The futures markets are really quite vibrant in Bitcoin, and now there's an ETH-based futures market as well. So I think those kinds of things get us thinking more about maybe taking a fresh look. But again, we'll have to see what happens with this current crop of applications.
You mentioned SPAC's popularity reflects to some extent the costs of an IPO. How might we reduce those costs and make IPOs cheaper while still providing protection to investors?
I think that's a great question and one we need to do more thinking about. So I welcome your feedback on what we can do on that. I'm always looking for ways that we can, revisit our existing regulatory framework with a mind to achieving investor protection as best we can, but also not putting undue regulatory requirements on folks. And so I don't have any specific solutions yet, but I'm all ears if you all have them.
Another question from the YouTube live stream. It is interesting that a former chairman of the SEC is representing the defendants in the Ripple case. Does this mean that the issues raised by the case were not raised during her tenure at the SEC?
I cannot speak about the Ripple case because it's one that the SEC is currently in litigation on. So I'm going to have to pass on that one.
Another question, aside from just generally bringing a greater knowledge of cryptocurrency and blockchain, what changes do you believe Gary Gensler may bring or focus on in regard to the SEC crypto regulatory regime?
Well, I think one basic point to remind everyone about is that if he comes in as chairman, Gary Gensler will be facing a whole array of issues, and crypto is certainly one of those. And I think, given the growth in the space over recent years, and given his knowledge, it's one that he will spend some time thinking about. But I really do think that clarity is kind of the first order of business there. Of course, I hope that he'll be amenable to something like the safe harbor that I proposed. I think that's something that I'm going to urge him to consider. But then outside of crypto, there are just a lot of issues. I mean, I think the events around GameStop and the other meme stocks, I think, we're looking at that as an agency, and that's going to, I think, that investigation of events and examination of what happened and consideration of any regulatory changes that might be warranted will take some time, as well as the many other things on the agenda, that I'm sure he'll have when he comes in. So it's always a fight for bandwidth at the commission level to get the attention of the chairman and to get something on his policy agenda.
Another question is that our company, would you welcome a change in the tax code to help equilibrate taxes on debt and equity for public traded companies as a way to encourage equity financing as opposed to debt financing?
Well, I'll happily say that that's really outside of my purview too, even though it does deal with, the balance between equity and debt financing tax policy. I have to stay out of that one probably.
And another question is about the evolving regulatory nature of a token from being a security to a commodity. When is that possible, and are there any other tokens that have morphed similarly?
I mean, I think that's the big question. I've asked the question, though, whether we should even be thinking about the token itself as being the security. And maybe that's where some of the confusion and the legal confusion have come, is by putting too much emphasis on thinking about the token as the security. Because if a token is a security, it's very unclear to me how it moves around a network. And because once something is a security, there are all kinds of rules that apply to how it moves, how you're holding it, all kinds of questions. So we really should, I think, rethink that view and instead look at, when something's an investment contract, the token is part of the investment contract, but it is not in itself a security.
All right, thank you so much. We don't have any further questions. Thank you so much for being here today.
It's been a pleasure, and I appreciate all of your time, and I wish you the best for the rest of the conference, and urge you to think about these questions, because I think there's a lot of great stuff for you all as law students to be thinking about and writing about.